Hi everyone, welcome back to the channel. My name is Nakul, and in today's video, let's have a quick look at where the economy is at and then talk about investment strategies during a recession. As of today, the 5th of July, which is the day I'm recording this video, the S&P 500 is down 21% from all-time highs. The Nasdaq is down 30% and most indexes globally are down as well, whether that be India, China, the UK or Europe. The US has been in a bear market for the last month or so now, and on the 28th of July, the Bureau of Economic Analysis is going to release their second quarter GDP estimates, which are projected to show another quarter of economic decline. So the US will officially be in a recession. The Fed has slashed its GDP growth projections for 2022 to 1.7% from 2.8%. The central bank has lowered its growth expectations for 2023 and 2024. The target Fed fund rate for 2022 to 2024 is between 3 to 4%. So the rate hikes don't seem to be stopping anytime soon. And I could continue mentioning data points that are not looking great for the rest of the video, or show you my portfolio that's been draining my savings for the last 8 months. iShares Core S&P 500 ETF down 21%, iShares MSCI China ETF down 13%, ARK down 55%, Trade Desk down, Teladoc down, VTI. But my question is, during this period of negative sentiment, when the market is officially in a state of extreme fear, how many of you are investing your money? For those of you who are you investing a lot and doubling down on this dip? Or buying just a little bit? And for those of you who aren't investing, when are you planning to hold back till? Are any of you selling? Let me know your rationale in the comment section below. Right now, there are really two schools of thoughts when it comes to what's going to happen next in the market. Some investors are calling this, and I quote, a once-in-a-generation buying opportunity, which seems like kind of a stretch, because if anything was a once-in-a-generation buying opportunity, it was when the market fell at the beginning of 2020, just before the Fed started pumping money into the economy. But I get their point. The market has fallen more than 20%, and some of the tech stocks that we all loved so much a year ago have fallen 60 to 70%. And they're at levels we would have jumped at a year ago. Plus, the fact that we're in a state of extreme fear definitely is a signal that we should be buying because, Warren Buffett said so. But on the other hand, we have investors who are looking at the index valuations right now and are correctly pointing out that even after this 20% decline, the market is still technically overvalued. The price to earnings ratio of the S&P 500 is currently around 19, which is above the historical average of 15. And with upcoming earnings expected to fall, the market could still have quite a lot of downside. So with these two opposing views, both with strong rationales, it's easy to understand why most of us are confused on how to invest during this period. Should you invest all your money because the stock market is at a 20% sale right now? Should you hold your money because a recession is coming? I'm not going to sit here and tell you I know which one of these are right, because they're both valid points, and if anyone tells you they know what's going to happen, they're lying. Because it's impossible to predict the market in the short term. But what I can tell you is over the long term, the market is going to go back up. At least that's what's happened in all of the 26 bear markets previous to this.
You never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up.
So it's important to keep investing into the market instead of keeping your excess cash idle. Because as we've mentioned on this channel before, time in the market will always beat timing the market. The longer you're invested, the higher is the chance of you making money in the market. And this has been proven over and over again using data points that stretch back to the 1950s. So not investing at all, also known as the playing dead strategy, is not a good strategy during recessions or bull markets. Because in this strategy, you're looking to time the market by waiting for the market to bottom. And we don't know when that is. We could literally already be at the market bottom. Not being invested when the market bottoms can be detrimental to the long-term performance of your portfolio. Half of the S&P 500 index's strongest days in the last 20 years occurred during a bear market, and another 34% of the best days took place in the first 2 months of a bull market, before it was clear that the market had bottomed and a bull market had started. In other words, the best way to weather a downturn could be to stay invested, since it's difficult to time the market's recovery, and missing the best days in the market can have huge implications on the long-term return of your portfolio. If you look at the last bear market and recession, which was the market crash of 2020, if we had invested $10,000 in the market once the market had fallen 20%, we would have approximately $14,200 today. But if we kept our cash idle for a year and then invested $10,000, we would have only $9,975. If we had invested $10,000 at the peak of the market before the 2020 market crash, we would have $11,268 today. So we would quite literally be better off investing at the worst possible time versus waiting a year and keeping our cash idle. I do want to say that this is just an example of a bear market and all bear markets are different, including this one. So if we aren't planning to time the market and we are planning to invest, there are two other investment strategies we can follow. Investing all our uninvested long-term savings at once, also known as lump sum investing, or periodically investing equal amounts of our uninvested long-term saving, known as dollar cost averaging. But before we start talking about investing into the market, remember to have your emergency funds set aside in cash or very liquid assets such as money market funds. The general rule of thumb is to keep 6 months of expenditure set aside for unforeseen circumstances such as losing your job or unexpected medical expenses. But during this time, if you're feeling unsure about the certainty of keeping your job or are just stressed about the market in general, increase your emergency savings to something that makes you feel comfortable, whether that be 9 months of expenditure or even a year. Though this usually isn't the most sound financial advice, during these periods of uncertainty, it's better to be relaxed versus stressing about the market all the time. Remember, any money you're putting into the market right now is money you don't need for at least the next 5 to 10 years. Another prudent step you can take during this time is paying off your moderate to high interest debt, especially if you have a variable interest rate loan. Because with inflation at record highs, we can see interest rates increasing another 2-3%, and your interest payments are going to continue to increase over the next 2 years. So focus on paying off these debts as soon as possible to avoid these higher interest payments. Now, back to dollar cost averaging versus lump sum investing. Let's go through an example of what these are. Say you have $1,200 to invest. Lump sum investing would be investing all $1,200 today, while dollar cost averaging would be, for example, investing $100 every month for the next 12 months, or $150 every month for the next 8 months. Basically, investing equal amounts at fixed regular time intervals, regardless of where the market is, because we aren't looking to time the market. Now, there have been multiple studies comparing lump sum investing versus dollar cost averaging, and in every study, it has been found that on average, lump sum investing does better than dollar cost averaging. Northwestern Mutual Wealth Management looked at a 10-year rolling return on $1 million over the last 70 years and compared results between an immediate lump sum investment and dollar cost averaging the money evenly over 12 months. The data shows that investing 1 million all at once generated better cumulative total return at the end of 10 years versus dollar cost averaging almost 75% of the time, regardless of asset allocation. If you're purely focused on performance and can stomach volatility, data shows investing a lump sum as soon as you can, regardless of where the market is, tends to result in outperformance over the long term, on average. But all the numbers and historical data in the world won't make me feel any better if I lump sum invest and then see a large sum of money decline 10, 15, 20% or more in value, which is definitely a possibility in this market. Though lump sum investing is a great strategy in general because it puts your money to work immediately, during periods of volatility, it does leave you susceptible to timing risk. So the strategy that I've been following and I will continue to follow during this period of volatility is dollar cost averaging. One of the biggest advantages of dollar cost averaging is that it takes our emotions out of investing by fixing how much we're going to invest and when we're going to invest, regardless of what is happening in the market. During periods of volatility, deciding when the right time is to invest is really hard. And so by fixing a plan ahead of time, we can follow a structured approach and remove our emotional biases from investing. It prevents us from making counterproductive decisions out of greed or fear, such as buying more when prices are rising or panic selling when prices decline. But remember, stick to the plan and don't let what's happening in the market change your dollar cost averaging strategy. Dollar cost averaging also limits timing risk since you're not investing all your money in one go, but instead breaking it up into small pieces and investing over time. If the market goes down once you start dollar cost averaging, by continuing to buy periodically, you're averaging down your entry price into the market. While if markets go up once you start dollar cost averaging, you're slowly deploying your cash and ensuring you're not missing out on too much of the upside. In terms of over what time period you should dollar cost average, 12 months is the sweet spot for me because anything longer than that means your cash is lying idle for way too long. And something shorter than that, like 6 months, seems too fast, at least for me. But find the time period that makes the most sense for you. I'm investing my money monthly because that's how often my salary comes in, but if weekly or quarterly makes more sense for you, you could do that as well. If you're following my strategy of dollar cost averaging over 12 months and investing equal amounts every month, you can simply take the amount of uninvested savings you have, add the amount you're planning to save over the next 12 months, and divide it by 12. For example, if you have $12,000 worth of savings and you plan to save $500 a month for the next 12 months, you have a total of $18,000 to invest over the next 12 months, which means you would invest $1,500 every month for the next 12 months, and after that, follow the same 12-month cycle on repeat. I hope you found this video useful. If you did, do hit that like button and subscribe. If you're looking for more tips for investing during a recession, check out this video where I go through the 5 tips for investing during a recession. I'll see you in the next one.